Hey, everybody. Hope everyone's doing well. If you're having issues with audio or can't hear me, just say something. But more likely than not, check the settings on YouTube. And that same goes for any quality issues. I had a glitch with my workspace that I have saved in the cloud. So I've got to rebuild it really quick. But while I'm adding a few lines, first thing I draw yesterday's high, yesterday's low. Yesterday's high is particularly important because it's a high one on daily chart, and that was right here. I'm going to use the Globex just because it's easier to see, but you can see we had a rally, big gap up, high one by yesterday, and the high one failed to trigger, and that's good for the bulls. That's good for the bears. The bears were able to prevent this bar from triggering and got a reversal down. There might be, I think there's probably buyers in this general area. We're testing the February 16th high. Go back to the daily chart. February 12th high, excuse me. We're testing that. We may have to get down to the February 16th high over the next couple of days. Overall, I think we're probably going to get closer to the moving average over the next couple of weeks. I think we're in a trading range on the daily chart. And we're in a channel, but I think this channel is going to start to go sideways. Bulls, they know they're making money buying below bars, and that's probably what's going to happen here. Just add a few more things that I know I want. We didn't quite reach that measured move. Last day of the month, and tomorrow is the last day of the month. Obviously, we're probably going to have a fairly bullish candle. Bulls, I don't think we're going to move that far. The midpoint is pretty far below. So I think we're probably, when we just zoom out of the chart, we're probably going to close the month somewhere in this overall area. 5-minute chart, we gap down, big bear bar closing on its low. It's a doji, and because of the size of the gap down, I doubt we'll go straight up. So overall, for me to buy, I need to see strong consecutive bull bars. Doji, probably sellers above, buyers below, and probably going to have a lot of trading range price action. Remember what I said, high one buy on the daily chart. Yesterday's highs a magnet, but with the size of this gap down, I doubt we're going to go straight down or straight up to the magnet. 2 consecutive bull bars, but we're near the low of yesterday. Doji on bar 1, probably sellers above 2, above 1 and above 2, scaling and higher. And then 3, now we have 3 consecutive bull bars. Good for the bulls. We might be always in long, but a lot of overlap, not ideal. Bears will sell above bars, and I suspect the bulls buying will probably scalp out knowing they can buy lower. 4, we have a bear bar. We rallied on 1, pulled back, rallied on 2, pulled back, rallied on 3. Now we have a bear bar closing on its low. It's a micro wedge on a smaller time frame. Plus, because of the size of the gap down, we'll probably get at least a small second leg down. And that's what happened with 5. 5, surprise bear breakout. Strong enough, we may go at least a little bit lower. But a decent rally from the one low and from the one low to the close of bar 5. Therefore, there's probably buyers in this general area. 6, inside bar, probably sellers above 6, buyers below 6, probably sellers at the breakout point for low. We rallied, went above the breakout point, pulled back a little bit, but I suspect there's also buyers below 6, buyers below 7. And instead, we broke to the upside. Now, why did we break to the upside on bar 8 instead of testing down to the 6 low or the 7 low? Because 7 is a low one short, and traders know there's probably buyers below the low one scaling in lower. And if it's a bad enough low one, like it is here, there's an added risk that instead of triggering the sell, if it's a bad sell signal bar below, most traders are going to buy it. And if too many traders want to buy the low, then move this up a little bit. If too many traders want to buy the low of bar 7, it's probably not going to trigger. And therefore, a lot of bulls start buying at the market just in case they don't get filled. And that's what happened with 8. 8, strong enough bar, probably going to go at least a little bit higher. And 9, doji. Disappointment bar for the bulls. Micro channel since bar 5. Bad sell signal bar below 9. So probably buyers below for at least a small second leg up. And then 10, you can see what happened. The bulls who bought the 9 low right here, their entry price was 6 even. Let me do it like this. And the high of this bar is 775. So the market went 7 ticks above the low of 9, but didn't allow traders to make a 2-point scalp. Bear bar closing on its low with 11. Probably buyers below scaling and lower, and at least a second leg up, but we may have to test down to the bar 6 signal bar high, which is what happened with 12. So traders bought, scaled and lower, and that's what led to a second leg up. 13, bull bar closing on its high. Possible wedge, 3, 9, and 13. But I suspect we're probably going to go mostly sideways here. For the bears, they hope that 14 is a bear bar closing on its low, undoing bar 13. More likely, we're in a trading range, and I suspect we're probably going to go mostly sideways. And then 14, bull bar closing on its high. Again, wedge, 3, 9, 14. Bad sell signal bar below 14. Lowers the probability of traders selling here. For me, if I'm going to sell, especially with strong bull bars, 6, 7, 8, and then 12, 13, 14, in their consecutive bull bars, I need a strong bear signal bar. Otherwise, I don't think a lot of traders are going to be interested in selling here. 15, inside bar. There might be sellers above, but overall, you're breaking out of the opening range and the moving average. And to me, that's an inside bar after a breakout of the moving average and the high of bar 9. There's added risk that the bears selling above 15 will get trapped. 16, doji bar. Some of the bears who sold above 15 ended up getting out in the bottom third of 15, seeing this as a trading range bar. And that's why 16 and 17 are bull bars. You're getting a deeper, an extended micro channel from 12 to 17 right here. So there's going to be buyers below scaling and lower. And that's what led to a breakout on 18. 18, bull breakout, climactic bar, possible exhaustion. And then 19, we went even further. So if you ask yourself, is 18, 19 the start of a new breakout? In other words, we had a breakout here and a channel and then a breakout here. Or is 18 and 19 more likely a buy climax testing some sort of resistance level? It's probably some kind of buy climax test of resistance. You can see we had a channel 14, 15, 16, and 17. This was the start of a channel. Channels typically evolve into trading ranges. But when you get a tight channel like this, basically a micro channel, which is the tightest type of channel you can get, when you get one of those, there's a greater risk of an upside breakout. In other words, trend resumption. So we had a breakout, 13, channel, 14, all the way to 17, and then we broke to the upside on 18, and that's what led to the measured move. 18, 19, strong enough breakout, second leg up likely. But you can see there's profit taking on 20. For the bulls, probably buyers below 20, scaling and lower. Some of the bears who sold the close of 18 and more higher are disappointed, and they'll probably use any pullback to buy back their shorts. 21, bear bar closing on its low, probably buyers below 20, and at least a bounce back up to the 19 close. So probably sellers above 21, but the sellers may not come in until a couple of points higher near the 19 close. 22, bull bar closing at the 21 high, but it's the entry bar for the high one. And again, there might be more sellers above than buyers. And that's why we got a bear bar on 23. 23, disappointed bulls who bought the close of 19, scaling in lower, getting out around break even or around their first entry here. You can see that's the close. And the close of this bar is 6.5. And the high of this bar is 6.25. So we came within one tick of the high close of 19. And that's why we turned down. 24, bear bar. Weak entry bar for the bears who sold the low 2. The second entry sell below 23. But it's also a bad high 2 buy signal bar after consecutive buy climaxes following a rather large gap down. And that will lower the probability of bulls buying above 24. Tight bull channel, and in other words, a micro channel from the 12 low to the 19 high, probably buyers below and more sideways, which means we're probably going to test somewhere up in this area and probably even test back up to the 20 high. And instead, we got a bear breakout below the wedge, below the high 2. 21 was the first buy signal bar for the bulls, even though it was bear bar. 24 was the second. And we went outside down on 25. But the reality is there's probably more buyers below 24 and below the 18 low, the bottom of the most recent buy climax. So bulls, they buy anywhere, they buy more at the 18 low, and that's why 26 reversed up. 26 strong enough reversal. We're probably going to test up to the 19 close and the 20 high. And that's why we got a consecutive bull bar. 27 for the bulls, consecutive bull bars, but high in a trading range. I suspect that there's going to be more profit taking up here than buying. As strong as 26 and 27 look, 27 overlaps a lot of 26, and that lowers the probability of 27 leading to a strong rally. What are the chances this is the start of a small pullback trend? This pullback is a little bit too deep, and we're testing the moving average early. Both of those reasons increase the probability we're in a trading range here. Doji, 28, more disappointed bulls exiting longs above the 23 high, or a retest of 19 close. Cool. There we go. Consecutive bear bars, 28, 29, inside bar, low probability sell, probably minor reversal. 30, almost outside down bar, but again, minor reversal, buyers below scaling and lower. 31, reversal up, but a weak stop entry, middle of a tight trading range, probably sellers above after 3 consecutive bear bars in a 4-bar micro channel. Bear bar 32, probably going to go mostly sideways. There's probably buyers below, but the risk you have is you're in the middle of basically a triangle with a lot of tails here, here, and here. And we had an opening range in this area. Opening ranges often get tested. You can also call it a trending trading range day, trading range here, bull breakout, trading range here. So it's reasonable to expect a test of the prior breakout point somewhere over here. 33, doji, bad buy above 33, trading range, so pretty much 50-50 probability. And then we got a surprise breakout, 34. 34, possible sell vacuum test of a 25 low and a higher low. However, tight bear channel, negative gaps, and 34 is breaking below the moving average. And the bulls who bought the moving average have not really been able to make any money other than a point or two. So this might trap the bulls into a bad trade. It's possible 35. Excuse me, it's possible 35 reverses up as a bull bar closing on its high. But I think more likely we're probably going to go sideways. Let me back up. It's possible 35 is a reversal up closing on its high. But I think the best the bulls can expect is sideways, which means you'll have bears, some bears selling the close of 34 and 35 if it's strong follow through. Other traders will sell the close of 35 if it's a weak bar. And 35 is not a strong bull bar to buy, which means there's probably sellers above. And some bears, they'll sell the close of 34 and sell more during 35 once it closes, betting on lower prices. 36, surprise bear breakout. Possible parabolic wedge, 1, 2, and 3. But a micro channel since the 28 high. Low probability sell on the 36 close. We're probably going to bounce here, but if you're selling in this general area, it's a little bit difficult trade management wise. And because of that, I think it's it's probably better to look to sell a pullback. 37, surprise, breakout down, but a lot of tails below. Makes me think that we're going to test back to the 36 close and maybe somewhere up here over the next several bars. But the sell off down to the 37 low is tight enough that there's the first reversal up will probably be minor. And you can see we came really close to the open of the day. Probably going to get to the open of the day, but with these tails, I suspect we're going to get a pullback first before we get to the open of the day. Bear bar closing on its low, 38, but we sold off on 37, rallied 38, sold off on 38. If we rally on 39, it would be a micro double bottom. And that's what happened with 39. For the bulls, strong enough bar will probably go at least a little bit higher, but you're buying it after a tight bear channel. And that will lower the probability for the bears, for the bulls buying above. And consecutive bull bars, 39, 40. Is it strong enough for a second leg? Well, the issue I have with buying above 39 is if I'm going to buy above 39, I want 40 to be the world's best entry bar. I want it to look like this, bar 58. I want it to race up. And 58 is not the greatest example because if you remember, 58 rallied and then went sideways for a lot of time. I want it to be a strong bull bar. In other words, the market sold off on the open of 40 and rallied and then pulled back into the close of bar 40. And that's a warning. It's trend line break. The market rallied from the 39 low to the 40 high and then pulled back, which means this bar right here, 41, going above 40, is in essence a trend line break and a retest of the prior extreme, the prior bar high. And that will reduce the amount of traders willing to buy up here. And that's why 42 is bear bar closing on its low. You can see the momentum is getting weaker for the bulls, and more bulls will look to exit. Is 39, 40, and 41, along with 42, strong enough for a second leg? It might be, but the sell off all the way down here is strong enough for a second leg. So you're basically buying a pullback from this overall breakout to the downside. And because of that, if it starts to stall, you may have traders give up and look to buy lower. And bears, they'll start selling, betting on a retest of the 39 low. For the bears who sold the close of 38 or the low of 37, same price level, they probably scaled in higher. And a lot of those traders are going to be disappointed. And if they're disappointed, what do you think they're going to do on a retest of the 39 or 38 low? You know, a lot of those traders are going to look to buy back their shorts. Bear bar 43. Good for the bulls. Good for the bears. Probably going to go at least a little bit lower. A lot of the bulls who bought the low 142, you see what they did. They bought this low and the market retested in the upper third to the middle of 42 and turned back down. And a lot of those traders, let's just see, they scalped out. 77.25 is their entry, and the high of this bar is 78.75. So the bulls, they were able to make a 1-point scalp. They couldn't make a 2-point scalp. 44, 3 consecutive bear bars, big tail below 44, increases the probability of buyers below scaling and lower, and a reversal up on 45 or 46. 45, reversal up, bull bar, closing on its high. Strong enough reversal that always in bears will exit above 45 and bulls will look to buy. I think we're going to test back to this area. It is reasonable to buy in here and scale in lower. 46 consecutive bull bars, probably buy the close and going at least a little bit higher. Bulls want a measured move target here. 3 consecutive bull bars, 45, 46, 47. Buy the close, probably going higher, the middle of the trading range. We might be forming a triangle, which means we may get a lower high here and test back down to the breakout point, the 41 high. 48, 4 consecutive bull bars, still buy the close. But unless we break far above the highs of 28 or 20 bar 20, we're probably going to go more sideways. 50, 49, another bull bar. It's a micro channel. As strong as the rally looks, there's a problem with it. Why are we getting this rally here and then starting to go sideways? So you see good bull bars and you're thinking, gee, that's really good for the bulls. We're probably going to go higher. But what do you notice? We're not going a lot higher. I want to say something real quick about the 60-minute chart. You see what happened here? We had this really strong sell-off here. And let me do it like this. We had this really strong sell-off down here. And it was a strong enough sell-off. It was likely to get a second leg down, and the first reversal up would fail. The market rallied, pulled back, tried again to rally, pulled back, tried a third time to rally, and went sideways. Strong enough bar. The bulls got a small second leg up, but the whole thing formed a trading range. And the bulls, they ran out of energy, and the market retested all the way down here. That's really common in trading ranges. Trading ranges, you get these really deep pullbacks to beyond a support level, a resistance level, like the high of these consecutive bear bars. Price went barely above it, stayed below these lower highs, and tested back down. It's backed over here. As strong as this is, it really should be breaking out above more bars, and that increases the probability we're going to go more sideways here. 50 inside bar, probably going to go more sideways. Because we're in a trading range, we are always in long, but we're at the top of the trading range. And because of that, I suspect there's buyers below scaling and lower. 51 outside down. This should not be happening if we were in the start of a strong bull trend. And because of that, I suspect, I did not mean to remove that. Because of that, I suspect we're going to go more sideways than straight up. We need to break above this range right here. 52 consecutive bear bars, probably sellers above, second leg down. 53, high one buy, but a high one in a trading range, high in the range, probably sellers above. 54, bull bar closing on its high, but then of course we got the second leg down. 55, and then 56, strong bear breakout. 56, trapped bulls. You had bulls here who bought and scaled in lower. Maybe they bought above the high one. Other bulls were waiting for a high two. And instead of getting a high two on this bar right here, 56, the bears broke to the downside. So the bulls looking to buy a pullback and the bulls who bought, scaled in lower, both are trapped. And the bears who were not short, they're trapped into a losing position. They're trapped out of a winning trade, and therefore they're going to look to get short here. We could easily get a pretty strong breakout. Second leg trap, leg one, pause, leg two. Second leg trap was basically in this area right here. And whenever you get a second leg trap, usually you'll test the low of the second leg, bar 44 or 45, and start to go sideways. Bear bar 56, probably going to go at least a little bit lower. It's probably always in short. Strong bear bar 57, but bottom of the trading range. And selling in the bottom of the range has not worked all that well today. Bear bars 51, 52, 53. That's leg one. Pullback 54, 55. This is leg two. What about selling the close? There's a tail on 57. And because of that tail, you'll have some traders hesitant to sell the close at 57, betting on a deep pullback. And you can see that's what happened on 58. 58 went below 57 and immediately reversed up. What about buying above 58? You're buying after three big bear bars after a surprise. And the bulls who bought anywhere in here and more lower, guess what they're going to do? They're probably going to look to sell in here. 59, doji. It's a bad sell below 59, but it's a bad entry bar after this rally up here. And because of that, you have bulls buying the 57 close right here, stop below. And a lot of those bulls who are long, they're hoping to get a strong entry bar. So they're looking for this. They're looking for 46, 47, 48 during the next consecutive bars. And instead, they got a weak bar after a strong bear breakout, 56, 57. A lot of those bulls are going to reduce their position. And the reason is there's too much risk we're going to go lower. We had a strong breakout, 56, 57. We still might get a measured move down. Plus, we have the open of the day not far below. And trading ranges are filled with deep pullbacks. Do you see what happened right here? The close of 57. You had some bulls buying the close of 57 right here, hoping for a second leg trap. Leg one, pause, second leg. And a lot of those bulls, they hit, I say a lot, there were some bulls who bought at the market, hoping this is exhaustion. And then the next bar will be a huge bull bar. And instead, the opposite. The next bar was a big bear bar. Some of those bulls who bought, scaled in lower, what do you think they're going to do on retest? They're going to sell. You have other bears who look at this and say, Yeah, I don't know. Maybe it's exhaustion. I don't want to sell the close of this bar because what if the next bar is a big bull bar? I'm going to wait. And then they say, darn, I should have sold the close of 56 because 57 was a big bear bar. Well, same logic. What are they going to do at the close of 56? They're probably going to sell. And that's why we tested close to it and pulled back 60. 60, 2 bar reversal, bear breakout below the low one, 59. Because 59 is a bull bar, I do think we're going to have to test back to the 59 low. However, my concern is it could take a long time. We have a strong bear breakout, second leg down is likely. And therefore, I think it's reasonable for bulls to exit below 60 and look to buy again above a bull bar. 60, 61, strong enough breakout, probably going to get at least a second leg down. And 62, test to the open of the day, but a tail. What does 61 and 62 tell us? 60 is a big bull bear bar. 61 is a smaller bear bar, smaller body and a bar. 63 is an even smaller body with a climactic tail. So a failed breakout below 39 and the open of the day. That increases the probability we're going to go sideways here and probably reverse up soon. 63, test of the 62 low, but probably buyers below. 64, we tried to break to the upside, break above 63, break above 62, pulled back. 64, buyers below for a second leg up, and that's what happened with 65. 65 broke below 64, 63, and 62 and reversed. What about buying above 65? It's an okay swing buy. I think the always in bears definitely get out above 65. And 66, decent follow through, testing this low one. Always in long, but we're getting back to the middle of the range, and that's a dangerous area for traders to be trading. And you see what happened with 67? 67 is kind of like 57. Instead of bulls buying into the close of 67, bulls started selling into the close of 67. Bulls and bears. And that's a warning that we're probably going to pull back. Tight bear channel. We're getting high in the range. This might be more of a sell zone than a buy zone. And that's why 68 reversed down. 68 probably buyers below scaling and lower. Same thing, 69. 70 bull bar, but I suspect there's probably sellers above for at least a small second leg down, but I suspect it's mostly minor. The reality is there's bulls who bought up here and more lower, and you know they're probably going to make money. 71 bull bar, it's a doji, and you can see if you sold above the high of 69, you sold above the high of 70, you could have made a small scalp. Limit order bulls know that. So the bulls were buying a pullback of 69 and 70 during 71, and that's why we turned up. What about selling the close of 71, scaling and higher? You can, but the reality is if you're selling here, you probably have to sell more above 67 if it gets there. And part of the reason for that is you had bears selling above the high of 60, above 70 during 71, and the bar went straight down and reversed up. So it's in essence a micro double bottom. We sold off, rallied, and we even sold off again. So it's becoming more dangerous of an area to sell. And that's in part why 72 reversed up. 72, bull bar closing on its high, but a tail 70 on bar 70, tail 71, tail 72. We're probably getting more into a sell zone than a buy zone. 3 consecutive bull bars, good for the bulls, but a lot of overlap. 71 overlapped most of 70. 72 overlapped a lot of 71. It'd be better to see a strong bull bar. Look at this bar. Look at 34 and how it overlapped very little of 33. Look at 56 and how it overlapped very little of 55. Those are signs of strong breakouts. 73 bull bar, but again, overlapping a lot of the prior bar, all of the over bar actually. And because of that, 74 is a weak bull bar. When I say overlap, what I mean is the high of the current bar, 73, is below the high of the prior bar, and the low of 73 is still within this range. So it's an inside bar, and that's a weak breakout. Technically, inside bars are not breakouts at all. And then we got a bear bar closing on its low, and then we pretty much went sideways into the close. Consecutive bear bars, second leg down here, and we found buyers. Big bull bar here, but it found sellers. Stop entries. Let me talk about always in. Always in, You can sell below 4, but lower probability. You can take the sell based on the gap down, not ideal. And then where do you buy? Tough call. You can buy above 8 and put your stop below 5, taking a chance it's the low of the day. Not all that clear. Otherwise, you can buy above 12, you can buy above 13, and traders can pretty much, there's no reason to get out of shorts here or out of longs. I think bear bulls can get out below 20, they can get out below 23, but if they do, they probably buy again, unfortunately, above a bull bar like 26. But if they do, trading range, they get out below 29. Bears can start selling. Some will sell 29, some will sell 32, others sell the breakout below 34 during 35. And those traders probably get out above 39, knowing it's a minor reversal. So if they get out above 39, tough call. Some will sell again below 42. Others will wait for more clarity. So maybe 30, 43. But if they're selling 43, they know there's buyers in this general area. So what are those traders going to do? If you're selling low in a trading range, in the middle of a tight trading range here during 43, and 44 tries to break to the downside but tests the low close and starts to reverse up, a lot of those bears are going to start buying back their shorts because they know the risk of 45 is just too great. And then 45, strong reversal up, 46, follow through, always in long above 45 or 46. And traders probably get out below 51 or 55 and they wait for a second entry buy. But we never got one. Instead, we got the bear breakout 56. So bears start selling. And I don't think they have to get out above 58, but they certainly get out above 65. And the bulls, they can buy again above, the bulls can buy above 65. And this is really just a mess for swing trading. If you're buying 65 and you see the tail 66 in the middle of a trading range, the risk is actually pretty good that you could get a buy vacuum test of the 65 high. Bears sell the 65 high, they sell more higher, maybe once or twice higher. Some bears sell a measured move up like this. So they sell here, they sell more up here. They get back out, break even at their first entry. Other traders wait for a rally here, and then they buy more back at the breakout point here for a second leg. And that's pretty much it for always in. Limit orders, sellers above 1, sellers above 2, buyers below 3, even buyers below 4. But if you're buying below 4, you buy more down here. You don't sell down here. Buyers below 9, any of these bars, I thought buyers below any of these bars, but micro channel from 12 to 22 or 20, that's an 8 bar micro channel, and the risk of a deep pullback is greater. So buyers below 22, but sellers above 22, buyers below 20, excuse me, but probably sellers above 21 or 22 for a second leg down, buyers at the moving average, sellers above scaling in, or sellers at the 19 close. I thought sellers above 31, but it never triggered. And buyers maybe 50%, but tough to buy all the way. Tough to buy 50% because we could easily fall below 12 and reverse up. I thought buyers below 41 or 42, but if you're buying there, you got to buy more at the breakout point or the low close, which is the area where the bears got trapped down here. What about selling above 44? I would not. You have a lot of bears buying back shorts, disappointed after 39, 40, and 41. I'd rather wait and see stop entry. 45 is a strong. If I did sell above 44 and I saw 45, I think you have to get out of shorts because there's too much risk of reversal, 45. And then probably buyers below 50, buyers below 51, sellers above 53 or 54 because of the tight trading range. Consecutive bear bars, 51, 52, so a second leg down likely. And then buyers below probably 57, even though it looks scary because of the tail and the context, but also sellers above 58 and buyers below 63, 64, buyers below 67, but probably sellers during in this upper portion of this range. And there's other limit orders, but that's probably a lot of them. Buy the close, sell the close. I thought it was probably buy the close on maybe 14, 15, 16, break out of the opening range. Even 18 and 19 are by the close, but you need a wide stop and be able to, and the ability to scale in. Probably sell the close 34, maybe 34, 35, 36, 37, but really hard to sell closes when you get a lot of overlapping bars and dojis. Even sell the close at 38 if you can use a wide stop and scale in higher on 39 and 40. But a lot of traders, I think a lot of traders would rather, if they did sell the close at 38 and then they saw 39, I think a lot of those traders would rather take the loss above 39 and then wait to sell again somewhere around 42 or when 43 tests the high of 41 right here. So we get a bear bar and then 43 turns up, testing the high close, reverses down. A lot of traders will start selling in this area. By the close, probably 46, 47, 48, 49. And then when you get 51, 52, a lot of those traders start selling back at the high close, betting on a trading range. Probably sell the close 56, maybe 57, but 57's late. It's fairly low in the range. So if you're selling 57, you got to sell more above 58. And you got to be fairly confident in what you're doing. This was a strong enough sell off for a second leg. And then 66, 67, really tough to buy the close or sell the close there. Let me take a look at questions. So give me just 1 second here. Sometimes when I have a thought about a chart, what I wanted to mark up, let me get back to over here. I wanted to mark up these bars right here. So 34, whenever you get a breakout with a little overlap, so 34, this bar right here, this bar right here, whenever it overlaps very little of the prior bar, especially if the prior bar is a strong breakout, it increases the chances of getting follow through. That's really what I wanted to make a chart on. It's one of the things that can really help you with your trading is make examples of charts. Okay, let's see here. So taking a look at the questions. Okay. If you are a strictly always in trader, is this a day where you're probably going to get trapped on bars like 38? Ah, yeah, that's a very good question. So this is the problem with always in a trading range. You see these tails, tail here, rally here. So tail 36, tail 37, rally 38. On a 1 minute chart, that's a wedge. And wedges are not very friendly to traders, especially in a trading range. That's around 11:30. So let's do this. You see this right here? What do you notice about this shape? 1, 2, 3, 4. It's consecutive sell climaxes. So here's bar 34. Here's bar 35. This is bar, excuse me, this right here, 1134 with the big tail. That's this bar right here. And you can see we sold off, rallied, which is here, sold off here. And then we got an even deeper pullback. 1, pause 2, pause 3, tested the lows. So that's what I meant by 39. A lot of traders, they might buy above this bull bar here, which is bar 39 on the 5-minute chart. But look what happened on 40, 41, and 42. 40 rallied, and then we got a lot of overlap. We formed a lower high here. That lower high is this bear bar. So when you look at smaller time frames, you start to realize, hey, these bars, even though they're consecutive bars, there's a lot of overlap on those bars, and those overlaps are wedges on smaller time frames. But yeah, if you're selling down here, it's really difficult. A lot of traders don't like to trade in the middle of the range. And if they do trade in the middle of the range, they use a wide stop because they know they just about always have to scale in. Question, if you put a limit order to buy below 22, right? Put a limit order to buy below 22 right here. Betting that the bulls will retest the close of 19. Okay, so you're saying buy the low of 22, betting on a retest of the close of 19. Question makes sense. So they're saying it's buy the close bar with 19. And then we got disappointment. We should test the high close. Haven't yet. Okay. We tried here, but we didn't reach it. I'm going to place a limit order below this low to get long. Where's the most reasonable stop? The problem with scalps is when you're scalping, placing limit orders, it gets very subjective really quickly. So for me, if I'm buying, let's say I am looking to buy down here. Well, there's two issues. One, the first issue I see is that 23 actually came within one tick of the close of 19 and then turned down. And that's a very close retest, which means it's a trading range. At this point, we're in a trading range and we're in the we're inside the range of yesterday. So where do I think the market could go? Where's a reasonable stop? Well, I always want to put a stop below a cluster of support levels as long as my premise is still intact. I'm not going to put a stop down here because my premise is going to be long over before it gets there. So I'm going to think about the moving average. I'm going to think about the 18 low. In other words, I'm okay with seeing a breakout, but I'm okay with seeing this breakout to the moving average, but it's not clearly always in short. What I'm not okay with seeing is this extended breakout. At this point, we're already in a trading range, so the probability of a measured move down goes up significantly. Here, tight bull channel, first reversal down should fail. So if I'm long, I'm not putting a stop below 18. I think there's buyers below 18. I think a lot of traders, when they see this, they're going to get out below that bar and look to buy more lower. On the contrary, you can wait for a bull bar. But if you do wait for a bull bar, unfortunately, in this example, you would miss the trade. But most of the time in a trading range, expect deep pullbacks. Plus, we had a lot of tails in here, and that increased the risk of a deep pullback. Can you explain in more detail why looking for a second leg from bar 12 to 19 is a bad idea? So, why is looking for a second leg from bar 12 to 19 a bad idea? Well, it's basically a parabolic wedge. One, pause, two, pause, three. It's a large second leg trap, leg one, pull back, leg two. Whenever I see a breakout, I always look to the left, look to the left. A lot of bars. And that increases the risk that we're in some kind of a trading range. And as strong as this breakout is, it's a breakout of what? It's a breakout really of nothing. You're just a buy vacuum. It's a buy vacuum test of the prior day's highs. And because of that, one moment. Because of that, it's a strong enough breakout that the first reversal down will probably fail. But if this whole thing's a trading range, eventually we could test all the way down here. So I'm expecting a second leg. In other words, I'm expecting a retest here. Even if I bought this close, I'm confident that if I buy the close and use a wide enough stop and scale in and manage the trade, I'll make money. But when I start to see this, guess what I'm thinking? I'm thinking trading range. And in this case, I'm willing to buy down here. That's a trade I'll often do. Bear bar with a tail, just hit buy the close. The bear should not get a second big bear bar, especially one closing strong below the moving average. Reversal up, reversal up. Guess what we're doing? We're testing these closes. But at this point, we're in a trading range, and I need to see a strong reason to buy. This is not strong enough. So if I did buy above 27, hoping for continuation, what am I going to do with 28 and 29? 28 and 29 is a double top in a trading range. Therefore, that's a good enough reason to exit. All right, so where do we go tomorrow? We have a high one buy on the daily chart, and it failed to trigger. And now, I don't know why TradeStation does that occasionally, but anyways, we had a high one buy and it failed to trigger. And now we're retesting the February 12th close. The bears are hopeful they can get a downside breakout. More likely, I suspect there's buyers not far below. But if this whole thing's a trading range, the limit order bears who sell the February 12th high or who sell the February 16th high right here, this is the February 16th high. Let's go ahead and mark that. They should make money. And what that means is I think these are obvious magnets. And a lot of traders don't want to buy above it because they know we're probably going to fall below it. Overall, I think we're going to try and get back to the moving average. So I suspect for the bears, for me to sell, what would I need? I need a strong bear breakout. I suspect there's buyers somewhere in here. But the bulls, remember what happened. We sold off to the moving average, rallied, sold off to the moving average, rallied, sold off to the moving average, rallied. And that will increase the risk that we're going to sell off to the moving average again before we rally. But we'll see. Okay. Thanks everybody for watching, and I will talk to everybody very soon.